Apple is facing a lot of challenges. iPhone sale is slowing, and they are lagging behind in the AI arms race. Is Apple's golden era finally over? Today, I'm breaking down exactly how Apple can buy its way back to the top. Importantly, watch until the end of this video, because I will deliver my verdict on whether Apple stock is still a definitive buy. Before we begin, please note that everything in this video is for only entertainment and informational purposes and does not constitute investment advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Let's get started. For decades, Apple has been an iconic pillar of American innovation. From the MacBook to the ubiquitous iPhone and the pioneering Apple Watch, its devices are in the hands of millions and have profoundly transformed the way we live and connect. Apple's signature lies in its elegantly minimalist design and proprietary ecosystem, where hardware and software seamlessly converge to create an optimized experience that remains the gold standard. However, the company faces a critical juncture. This technology powerhouse is under siege, facing fierce competition from every direction. Apple's continued dominance and future growth hinge on its capacity to aggressively adapt and fend off these market challenges. The iPhone, Apple's flagship product, continues to be its most significant revenue generator. In fiscal year 2025, iPhones account for over 48% of the company's total sales. Despite this continued financial importance, the core iPhone segment has reached maturity and its growth has slowed considerably. Recent data confirms this trend, showing that annual iPhone sales growth rates have been in the lower single digits since 2023, confirming its position as a stable, mature product rather than the primary growth engine. Slower iPhone sales growth is not Apple's only problem. The company also faces a significant challenge in the artificial intelligence landscape. Its primary AI offerings, Apple Intelligence and Siri, have drawn criticism for often feeling underwhelming and lagging behind competitors in both raw capability and seamless integration. This relative shortcoming may be linked to the company's investment strategy. According to CNBC, Apple's AI investment is notably the smallest among major technology companies. In the fourth quarter of fiscal year 2025, Apple allocated only $3.24 billion to AI, a fraction of the tens of billions invested by rivals such as Meta, Microsoft, Alphabet, and Amazon. This is a risky approach that Apple is taking. Rather than prioritizing the development of its own proprietary AI, Apple has decided to entrust its AI future to third-party software, such as ChatGPT. The next question that we should ask is, how can Apple sustain its growth and expand its revenue streams? Perhaps I have the answers for you. Despite slower iPhone sales growth and other challenges, Apple successfully posted record net income in fiscal year 2025, marking a healthy 7.1% year-over-year increase. The key to this performance lies in the diversification of its revenue streams. Specifically, the services and wearables segments have emerged as the primary growth drivers. Their explosive expansion has more than offset the slower, more cyclical growth of the core iPhone business. Both these crucial segments have shown remarkable consistency, achieving high single-digit sales growth in the range of 8% to 9% across the fiscal 2023 to 2025 period. Apple is smart to switch from being just a hardware company to a strong services company. I especially like the fact that Apple is focusing on its Apple TV streaming service. Growing this service not only brings in new kinds of money, but also makes up for slower sales of the iPhone. Right now, Apple TV has very few subscribers in the US and globally. However, if Apple were to buy a bigger, more established media company with a larger streaming service, it could become a major competitor. I am referring to Warner Bros. Discovery. It is public knowledge that Warner Bros. Is looking for a buyer. Its main assets include its top streaming service, HBO Max, which has over 128 million subscribers worldwide. If Apple buys Warner Bros.' studio and streaming business, it would greatly improve its content library with famous movies and shows from world-renowned channel HBO. Additionally, Combining Apple TV and HBO Max would create a major force in the streaming business with a huge subscriber base. Furthermore, Apple is perfectly placed to make this purchase. At the end of fiscal year 2025, Apple had $132 billion in cash and investments. This puts Apple in a great spot to buy Warner Bros. Discovery, which currently has a market value of less than $60 billion. Another method for Apple to grow its revenue is to invest more in artificial intelligence. Since Apple is currently lagging behind other big tech companies, the best way to catch up is to buy an existing AI firm. Luckily, Apple has plenty of cash to make this happen. Possible acquisition targets include Anthropic, Perplexity AI, and Mistral AI. Buying one of these companies would allow Apple to quickly upgrade Siri and Apple Intelligence. Ultimately, better AI features could help sell more iPhones. My ultimate verdict is that Apple stock is still a definite buy. The company makes plenty of money, which will keep driving up its profits. Plus, with $132 billion in cash just sitting there, Apple can buy almost any company it wants to boost growth. They could pick up a media giant like Warner Bros. Discovery to help their streaming business, or buy an AI firm to make Siri better. We have to wait and see what they do, but I'm confident Tim Cook will make the smart choice. That's the end of this episode of Fundamental Focus. I hope that you have enjoyed this video. Please show your support by liking this video and subscribing to this channel for all future contents. Thank you for tuning in, and have a wonderful day.